Thank you, everyone. Thank you for sticking around for the graveyard shift to hear me speak. So my name's Rob Abraham. I'm the fund manager for Supermarket Income REIT. Just to take you through some of the highlights here. So we're the UK's only grocery platform that's listed. We've got 1.6 billion of assets. There's now actually 51 stores following our latest acquisition. We've got a 14-year weighted average unexpired lease terms, that long lease profile. We're listed on the FTSE 250. We've got a market cap now of £1 billion, and the dividend yield today we've got 7% there, but actually off today's closing price is more like 7.5%. So we think the shares represent pretty good value today. In terms of the reasons why investing in grocery real estate is attractive, we've got non-discretionary spend. So groceries, consumers will buy throughout economic cycles. And we see that coming through in our operator performance. We've got those long leases and typically inflation linked. So 80% of our leases have inflation linkage. And that's got strong tenant covenants with the likes of Tesco's and Sainsbury's on the other side of that lease. And rents, of course, are a priority payment for them as they want to retain access to their stores, which the next point being their mission critical real estate. These are on large sites. They're essential for our operators to be able to generate sales, and that's whether they generate sales online or in store. That's done through their store networks. They're future-proofed, so they're omni-channel stores. So that means they're performing online fulfillment with home delivery from those stores. And finally, we've got these tailwinds for market rental growth, and that's because you've got a lack of available sites. The operators can't find these 10-acre sites in densely populated residential catchments with ease anymore, and that just ensures that actually they'll want to stay in our locations for the long term. Just turning to the grocery market itself, so the market's going from strength to strength. We're seeing market growth of 10.8% now coming through, and the drivers of that, that's not a new phenomenon. We've seen £33 billion of growth over the last 5 years, and there's a number of structural drivers for that. Firstly, we've got the increase in working from home, so that's up 44% compared to pre-pandemic, and that's of course meaning that consumers are spending more time at home, and they're therefore consuming more calories in the home, which they're buying from their grocery stores. We're seeing grocery price inflation of 17% coming through. Now that's of course ahead of market growth, but that's because shoppers are price sensitive and they're smart, so they will transfer into volume into kind of basic ranges, cheaper product lines. That is still spend that's coming through the grocery operators. And finally then, the underpinned just by projected population growth in the UK, which is 3%. Up until around 2030, so that just means more consumers requiring more food. Turning to our current portfolio, so we've got a total now of 50 supermarkets, or 51 as I mentioned earlier with the latest acquisition. That's a unique portfolio that's been handpicked. So this has been assembled through individual store acquisitions. It couldn't be replicated. 93% of our stores are omni-channel, and I'll turn into it in a moment to what exactly that means. And we've got a very affordable average rent to turnover of 4%, where store revenues now are growing ahead of those rents, meaning that our rents become increasingly affordable for the operators. So a strong performing omni-channel store, what does it look like? This is Tesco in Thetford. This was the first ever store that Supermarket Income REIT purchased. The site size is 13 acres. You can see on the map on the left there, the dense residential catchment surrounding the store, and also the plan for 5,000 or 5,000 new homes, which are actually now under construction, which will support demand from the store. It's got a large car park. It's got 350 employees, so these are large businesses in themselves in each store. 13 home delivery vans operating from it, so this is a key online hub for Tesco, and all of this combined means that it's a strong revenue generator for Tesco. And just to take you through how that breaks down, so the total site revenue of £70 million per annum As I say, this is a significant business for Tesco in its own right. 70% of that comes from in-store sales, but then actually 15% now from home delivery. I mentioned those 13 home delivery vans. Click and collect is becoming an increasingly important channel. That's 5% of the store sales. And finally, the petrol station also bringing around 10% of that site revenue. So it's the combination, which means that Tesco will want to stay in this site for the long term and beyond lease expiry, which gives you good confidence in renewing that lease. Finally, you can see on the roof there, solar under development, and that leads me on to sustainability in a moment. But just to explain that omnichannel aspect, so it's the proximity to consumers that means that this is the most efficient method for operators to fulfill online. So on the map on the left there, each of those blue dots is a Tesco store from which they perform home delivery. There's around 350 of those. They have around 6 central fulfillment centres in and around London, those red dots, which are dark stores that perform online only. But by and large, it's omnichannel stores that the operators are using. And on the right-hand side of the page here, you can see why. And that's because delivery cost is the most significant element of fulfilling online orders. Now, the centralized fulfillment center model, i.e. that used by Ocado, you have a much longer distance to travel to your consumers because you don't have these local stores to fulfill from. That means that the delivery cost, or all-in delivery cost here, is around £14 for Ocado compared to an omnichannel store network at £9. And that's just why we're seeing likes of Tesco, Sainsbury's, all of the big operators using their store networks. Just to bring that to life a bit more for you. So the map on the left here is Ocado Dordon, the gold circle there in the centre, and that's up on the outskirts of Birmingham. Now this is located on a kind of commercial estate. In that same area, Tesco has 28 stores, omnichannel stores, which are performing both traditional in-store shopping but also online. That means within an hour's drive time of Ocado's site, there's 7.5 million shoppers. On average, Tesco can get to each of those shoppers in 22 minutes. It takes on average Ocado 60 minutes to reach those same number of shoppers. So that's why we see over 80% of online grocery fulfilled from omnichannel stores rather than the centralized model, which is as used by Ocado. And then just to touch on sustainability, so we're fortunate in the grocery sector that our operators are very committed to sustainability themselves. Tesco is the largest private consumer of energy in the UK. That's the largest is the NHS. So that means they're also absolutely committed to reducing their energy costs and their greenhouse gas emissions. And on that, we've seen Tesco enter into a new 20-year PPA for a solar array on the rooftop of one of our stores. We've also agreed terms for EV charging at 8 of our sites, and we're also working towards a number of the key initiatives to ensure that we're keeping up with our peers when it comes to reporting and setting targets for carbon reduction. Just turning to the investment market now. So the total market size for leasehold grocery property is around £85 billion. A large proportion of that does sit on operator balance sheets, so Tesco, Sainsbury's will own a number of the stores themselves. But there's still a sizable market which is in the leasehold, which is around 30 billion. But at Super, we target only the strongest performing stores. We target omnichannel stores, and we look for those on index-linked leases. Currently, we're around 1.6 billion of assets, so around 5% of that leasehold market. We think, sticking to our investment strategy that's very focused, as I say, we could grow to roughly double that, around a 10% market share in and around £3 to £4 billion of assets. So there is still room to grow there. Now, we have seen, following the rise in interest rates, a repricing of assets, and it has been rapid. The yields there had reached a low point of 4.6% around 2021, early 2022. that's now moved out to 5.9%. That's the gold line there, the supermarket yields. But what we've seen is in the last time assets repriced after the global financial crisis in 2009, supermarkets were effectively one of the most expensive asset classes at 6.3% yield. But actually today it's one of the cheapest at around 5.9%, as you can see on the page there. And this is the MSCI supermarket leases, not quite reflective of the quality of our portfolio, but the direction of travel explains that movement in yields that we've seen coming through. So our market is unique. It's very liquid, but it's unique in that the buyers, two of the biggest buyers of grocery property, are Tesco and Sainsbury's themselves. So in years gone by, they undertook large scale sale and leaseback programs. We're now seeing them buying back in assets, and that's a result of their strong performance at the moment, very high cash flow generation. And the vendors we see on the left hand side typically are from generalist property owners, the likes of British Land, Legal and General, Aberdeen Standard, generalist funds, and they're recycling into or potentially rebalancing portfolios into other sectors, maybe logistics, offices, general retail warehousing. And then there are specialists on the other side as purchasers like ourselves, Realty Income. But the real underpin there is the operators themselves. And of course, they're the ultimate insiders in this market. They understand this real estate better than anyone else, and they're spending significant amounts of capital to buy back in some of their best stores. And a good example of that, you can see Sainsbury's on the page there with 520 million of stock being bought back. And that was in fact a transaction with ourselves. So we did have a joint venture, 117 million into 26 Sainsbury's stores. These were on short remaining lease terms. But the real value here was that in these 26 stores was how strong performing they were. You can see in the map on the right hand side that they're weighted towards the southeast of England. Really kind of classic Sainsbury's catchment areas, affluent shoppers. And as a result, whilst these stores were 4% of Sainsbury's real estate by floor area, they're actually 7% of the total turnover. So on a relative basis, they performed very strongly compared to the rest of the portfolio. So that was the value that we underwrote, was that actually Sainsbury's would want to remain in occupation of these stores over the long term. And that came to fruition. So we've actually seen Sainsbury's exercise its option to buy back 21 of those stores for over £1 billion. They entered into new leases on 4 stores, and then just one of those 26 stores is to be sold subject to vacant possession. And that was something we'd underwritten at the point of acquisition. We identified that as the weakest store in the portfolio. But actually, by and large, Sainsbury's remaining in occupation. And it's been a very strong performing investment for Super. So total proceeds of 431 million due to be received throughout the course of this year. And the returns on that is a 1.9 times money multiple and an IRR of 30%. So that investment was over the course of 3 years, and Super has nearly doubled its money in that time. So just to wrap up on our investment strategy and why we're still very positive on Super and think it looks like very good value at today's share prices. As I mentioned earlier, that 7.5% dividend yield at current price. But the structural drivers for us, we've got long inflation-linked income, that 14-year lease profile. Our portfolio is weighted towards Tesco's and Sainsbury's. So that's 78% of the portfolio, and they're of course performing very strongly in the current environment. And it's that grocery spend, non-discretionary, as I say, where shoppers are always going to need to buy groceries. That just means we're seeing our stores perform very strongly and gives us good confidence that our operators will renew the leases. We've also got the future-proofed omnichannel stores. As I mentioned, 93% of the portfolio is omnichannel with these home delivery vans operating and the stores acting as last-mile distribution hubs for our operators. And that's been proven as the winning method for fulfillment of online grocery. So that is certainly here to stay. and it means our operators are able to flex between channels depending on shopper behaviour. And of course, we have seen online returning back to around 11% of the total market since returning from the pandemic highs of 15-16% of the total market. And then finally, we've just got the real asset backing, these large flexible sites, average site size in the portfolio of 10 acres, in densely populated residential catchments, that just gives us a great underpin for if for whatever reason one of our sites was no longer to be a grocery store, then it would have various alternative uses which underpins the value. So from where we stand today, we think Super certainly looks a very strong investment.